Sovereign debt is only less than a third of the total debt. Private debt will restructure at the speed of light if we have a strong enough downturn. That's the secret. It's the private debt that grows the most in a boom. The government benefits from the higher tax revenues and all that sort of stuff, okay, for doing nothing different, okay? Businesses have to grow and invest, and then when things go down, they cut, like I did. I was a turnaround manager. I can cut. The key is overheads, okay? Overheads are often 50% of expenditures, and you can cut them 30% in a blink and 50% if you really dig down in a crisis. And I've done that over and over again. People say, oh, you can't cut that, it's fixed. No, it's not fixed. It's fixed only in a short time frame. That's where the benefits are. So in a downturn, businesses cut back, the weak businesses go under, and usually they don't totally disappear. They get absorbed by a stronger business, which makes that stronger business stronger. So recessions and downturns make the strong stronger, weed out the weak, weed out waste, zombie companies, bad debts. Our problem is we take on debts and nobody wants to write them off. They only write them off if we have to. Being forced to write down debts, and that's what happens. Our private debt, which is about 70% of our total debt, could be cut in half, okay, in the right economy. And that's where and when that happens, the economy turns around and grows again, and then the government benefits from that. And if they don't keep taking on more expenditures, which they don't need to, then their debt ratios go down as well. But government is the place that you can't cut as easily. Yes, they can cut some expenses, but the government won't do it. When you go into a downturn, everybody almost looks, it's Keynesian theory, and I hate John Maynard Keynes. He's the problem. He was the worst innovation in history. He's the one that came up with, well, the economy's slowing, just print money and make it grow again. Something for nothing. Wave a magic wand. Printing money is waving a magic wand. It doesn't do what businesses do and what government also needs to do. Look down, where are you really making money? What's working? Where are you growing? And where are you not? And where's all that big, fat, juicy overhead that you can probably cut in half and never miss, because it actually does more harm than good. Nobody wants to do the hard way, the hard work, step by step, progress by progress, make your mistakes, admit them and correct them and move on, okay? People want it to happen magically. That's why when the government just started printing money, everybody's like, well, it sounds kind of hokey, but they've been doing it for 15 years now. And the economy's better. I'm telling you, the stock market's way higher than it would have been naturally, okay? Double at least, okay? Everybody's gotten a free lunch from that. So you have to first take the free lunch away to wake people up. That happens only in a downturn. And the only reason we get in a downturn, we so overstimulated that we created this inflation and this problem, and now we have to tighten. They've already tightened the most in 40 years. I'm not going to make any judgments on where the economy's really at until the end of the first quarter of next year. And I'm betting we're going to already be in a recession, and whatever the government's going to do now, a quarter point in late September, another 50 basis points in November, and another quarter point in December, isn't going to make much difference, okay, in this thing that's already moving forward. And these rate cuts are going to impact for a year and a half out at least, continue to, and that's into early to mid next year. So I think the die's already cast. It's just a matter of it hitting, and then we get the reactions. But again, recessions are not the enemies. If you have healthy booms, you'll have healthier, less dramatic recessions. We had the most debt-ridden, most bubble-ridden boom in all of history. I can't even compare this to the Roaring '20s or the 1820 to 35 bubble boom and bubble. Can't even compare these to this. So the bubble has to burst. And you can't keep a bubble going forever because it takes more and more to get less and less. The law of diminishing returns is what will kill any bubble. No bubble can go on forever. And this one's already gone 2.5 times the typical bubble, particularly stock bubbles, in modern history. Already gone 2.5 times as long. So this is already ending because it went to extreme, and that created the 9% inflation. And if they stimulate again, that inflation is going to come right back. That inflation was totally created by the stimulus. I show long-term inflations caused by workforce injury, which is because of the high cost of bringing a new virgin person into the workforce and economy. All the investments by companies to create an office and technology to that person, for the parents to raise them up till that point, which is $300,000 a kid on average for the average parent, okay? And governments, again, to subsidize until people become productive. People are a liability, an investment is a better way to call it, until they enter the workforce. And even that, it takes 2.5 years, I've found, 2.5 year lag before they start to produce more than they cost the economy and create booms and busts on a generational wave, which I can predict over the rest of any of our lifetimes in any major country in the world, including emerging countries, which I just use workforce because they're not as dynamically distributed in high and low incomes and stuff. But anyway, even in emerging countries, China is going to go down and slow no matter what anybody does, and they're doing all the wrong things. Overbuilding. They got 22% empty homes. What would our economy be if 22% of offices and homes were empty? We would be in a depression, guaranteed. China, since they control their economy and just tell businesses, just keep building this stuff for nobody, we'll cover your back, we'll cover the economy. Well, now they're having to cut back because they have more than twice the debt of other emerging countries and almost as much as a developed country when they don't have the standard of living of a developed country. They're at 19,000 GDP per capita versus our 70,000. That's how second world, they are a second world country spending and acting and borrowing like a first world country. And China is the first to be cutting back here. And China's going to have the biggest debt crisis in the world, not the US or Europe. This is a once in a lifetime event. I call it a great reset after a major bubble, and bubbles only come about every 90 years. Roaring 20s, and now is 90 years lag. And now we've had 2 bubbles instead of 1 because the second one's been artificial. So stretched it. You have to step away. First of all, keep your job. If you own your own business, do like me, be cutting costs, hunkering down, because the strongest businesses are going to survive. That's the whole purpose of recessions and downturns, is to make the strong stronger and weed out the weak, okay? Investors have to get out of the way. There's a simple place to go, and it's not cash. There's one investment that's already been proven when you have a strong deflationary downturn like 2008 to 9, already proven, Treasury bonds. 30-year Treasury bonds is the best single thing to put your money in because it leverages a slowdown or deflation. Long-term risk-free rates will go down while risk rates of corporations will go up because of failure. Well, the government's bonds are the ones that will not fail and stop because they won't let them. And those rates go down in 2008-9. 10-year Treasury bonds rate went to 0.4%, and the bonds appreciated almost 50%. This time I'm estimating TLT, which is average of 10 and 30-year bonds, 20-year bond average, will go from 90 something today to 186, and that's just a little higher than it did in the COVID crisis when it went to 173. You could double your money sitting in the safest long-term bonds on earth, the safe haven, even though the U.S. has a deep recession like it did in 2008, only worse. Well, we're the best house in a bad neighborhood globally, as we were there. All the people who compete with me about a crash, Peter Schiff and all these people, are saying the dollar's going to crash. No, the dollar is the safe haven. Look at 2008. It's the one currency that went up. So we're the safe haven country with a safe haven currency. You put your money in our treasury bonds, 10 and 30 year, TLTs and ETF you can buy like a stock and sell in a second, the most liquid market on earth, most liquid thing to buy, and make money in a downturn. And then when the downturn's at its worst, you start doing the opposite. You go back into quality real estate and stocks, because you're going to have another boom. We're going to have the millennial boom into 2037 before that starts to plateau. And so say 2026 or 2037, you buy stocks at deep discounts and real estate on sale, the best time you'll ever see, and you make money again. But now you can't be in a diversified portfolio of stocks and sectors and different types of bonds because they're all going to go down except the safe haven bond, the AAA corporates, the AA, AAA corporates, and even better, the 10 and 30-year treasury bonds. That's the safe haven, proven beyond a shadow of doubt in the 2008-9 downturn. And everybody else is, to all the other bears are telling you to buy gold and silver. Good luck on that. Gold went down 45% at the worst in 2008. Not bad compared to stocks and other assets, but went down. It was not the safe haven and will not be again. I expect gold go from 2,500 a day back down to 1,000, 1,200 in this downturn. Wow. And then I'd be happy to buy gold long term, not because of its safe haven status, because the next big boom is going to be in India, like China, for the next several decades. So I'll buy gold when it's back at 1,000, but gold is not going to do you well in this downturn. It will not protect you, as a lot of the hyperinflation crowd says. I'm in the deflation crowd. 2008 was deflation, but it was stopped. So 1930s was deflation. Not just economy slows, but financial assets go down even more dramatically. And that shrinks the amount of total wealth in the world and shrinks all financial assets, all of them, except as those safest safe haven bond. There is nowhere to hide. So most financial advisors say, well, if you listen to a guy like Harry, well, maybe he's right. Well, we'll diversify you in these 3 or 4 or 5 different global stock sectors, and you'll be okay. You'll ride it out. No, not this time. Not in a 70 to 90% crash like 1929 to 32. Those things are bubble bursts that annihilate almost all financial assets. There is no place to hide but the safe haven bond. It's just back to 2012 in real estate and the early 2009 lows of stock. It's not going back and erasing the greatest boom in history, just the last surge. And we should have peaked in 2007 anyway and gone more sideways until now, okay? Instead, they created the greatest stock bubble in history in one of the slowest economies in history otherwise by simply pouring in fake money. And it works short term, and it's worked for 14, 15 years. But when does it burst? Because it keeps going. Well, 525 basis points say the highest probability of this thing bursting is over the next year. If it doesn't burst in the next year, I'm just going to shut up and go hide in the woods down here in Puerto Rico. Fundamentally, for companies to grow in mass, overall, you have to have a growing economy from consumers earning and spending more money, okay? And you got the biggest generation in history already programmed to spend less and save for retirement. They're at their peak saving for retirement now, and then they're going to start spending down those savings. Those savings have been the financial asset bubble has not just been all the stimulus, it's been the baby boomers. As of 2024, this very year is at the peak of their saving cycle, which is age 63 is when people have the highest savings and investments, okay? Now the demographic trends of more money flowing into savings goes down as well, naturally. Again, you can't keep a bubble going forever on artificial stuff. There has to be real spending and or real savings, and ultimately the spending is the most important because businesses have to see growing demand for their product to invest in the future and expand and make growing profits. Savings only creates higher valuations in financial assets. So it's really the spending cycle that's the most important. And frankly, we're over the baby bust, okay? But again, the millennial boom is nothing like the 83 to 2007 boom in baby boomers relatively. And then that just plateaus. It doesn't grow, it doesn't go down, but it doesn't grow. It just plateaus for decades. That's never happened before in history. So a lot of things are happening never before. The thing is, if you look at the right indicator, spending on a 46 to 47 year lag, depending on the country, okay, or workforce growth in emerging countries, the technology cycle has 2 bubbles or 2 booms and busts every 45 years, so about every 22 and 20.5 years. We had the first bubble into the late 90s, and this is the second technology bubble, which should have peaked in late 2019, early 2020. So now that technology innovation cycle joins the slowing demographic cycles. And again, how long can you just print money? And by the way, they just stopped doing that. They just shrank the balance sheet 1.8 trillion in the last few years and raised interest rates from 0 to 525. That's the death knell. It's just going to take 6 to 12 months to see how bad it hits, and I don't even know that. I'm getting the hell out of the way and telling everybody on my newsletter, get the hell out of the way and see what happens here, because it ain't going to go up more, and it's not going to be pretty, whatever happens. And the safest place to be is in these 10 and 30-year treasury bonds, or TLT as an ETF. You can buy that in a moment, sell it in a moment.